Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to the first webinar of this week. It's a very interesting week for multiple reasons. We have, of course, got the consumer inflation tomorrow afternoon. After that, we have the Federal Reserve's interest rate decision. And then, of course, the day after that, we also have the producer inflation. So it's going to be a very important week. People may have not have seen a lot of volatility yesterday, but over the next few days, they definitely will be able to see a lot of volatility. Now, when there's a lot of volatility, especially if we're going to get news which all points into the same direction. So, for example, lower than expected inflation, lower than expected producer inflation, and also indications that there will 100% be an interest rate cut in September, then there is a scenario where it's all pointed in the same direction. There's a lot of fundamental indications that there is going to be a clear trend. Now, when we are going to see a clear trend, even if it's going to be a trend in the medium to longer term, we of course have signals and we have trading plans and we have short-term trading strategies in order to assist us to determine how the market is likely going to move in the short term. So to be able to actually pinpoint exactly that now there is going to be an opportunity at this price, at this time, for this period of time as well, that there's going to be a specific type of price movement. If we're able to predetermine this price movement, it's at that point within the market that we will see, that we will of course be able to see, right? There's an opportunity. We're able to predetermine how the market's going to move. We're taking advantage of that. And that is when you're going to become a successful trader, when you're able to determine this. Today, we're going to look at two strategies. We're not only going to look at one strategy. Today's webinar, I don't want to concentrate so much on theories, not more on educational factors. It's very straightforward. We're going to look at two very well-known strategies within the financial trading markets. So this is what we're going to be looking at today. Yes, of course, we will do an introduction towards the very end of the webinar. I will also include some additional factors that you can include in order to increase your success rate and the accuracy of these strategies. But 95% of the webinar, we're going to be looking at those strategies. Now, as part of this slide, I don't want to spend too much time as part of this slide. You know, me, myself, I've been a financial advisor for a very long time, but this presentation has been put together for educational purposes. It's here to provide you and educate you about these two strategies and about the financial trading markets. It's not here to give you direct investment advice. There's many financial advisors out there, and if you do want financial advice, then of course you can seek financial advice as well. But the purpose of this presentation has been put together to educate you on these two strategies. So of course I want everybody to be 100% clear about that. A bit about my background. Most people know me because I've been in the market now for 10 years, and I've been doing seminars and webinars and many events for approximately 6 years almost. But a bit about myself. Originally, I did start off only as a financial advisor. I was a financial advisor in London for 4 years. But like I said, I've been in the market for 10 years now. I've done many seminars from all around the world, including the Middle East, including in countries within Europe, such as Romania, Serbia, Greece, Turkey, the UK, and many other countries as well. But I've also done a lot of seminars in Africa and also in the Middle East. Today, though, what we're going to concentrate on, because each webinar is based on something specific. Today, we're going to concentrate on two trading strategies. Now, one of them is something that we've looked at quite a lot in this year, but we've had a lot of new attendees over the past 2 weeks that have said to me, you know, we keep looking at investor sentiment, we keep looking at fundamental analysis, but I actually want something to look at certain indications, certain check, should we say, making our own very checklist and to use that to determine right now there is an opportunity in the market, or now there isn't an opportunity within the market. So we're going back to trading plans. Now, at the end of each webinar, very quickly, I always do a poll at the end of every single webinar. And I will always ask traders what they think is going to happen within the financial trading market. Normally, traders are almost 100% correct. We've been doing these polls at the end of the webinars from the very beginning of 2024. Normally, traders are 100% correct. Sometimes we get a 50-50 scenario. Never have we had a trader, no traders actually be correct. So this is actually the first occasion. The question last week was slightly more tricky. We said which would be the best performing currency by the end of the week. That was on the 5th of June that we did that. We get many options in terms of currencies. Some people, 33% opted for the New Zealand dollar, same for the Japanese yen, same for the British pound. Nobody said the US dollar. The correct answer, ladies and gentlemen, the best performing of last week, also very well performing, also on Monday as well, yesterday, was the US dollar. Second was the British pound. So technically, very clearly, ladies and gentlemen, nobody answered correctly. But people that did vote, the 33.3% that did vote the British pound, would of course have a much better outcome by the end of the week compared to the New Zealand dollar and the Japanese yen. Unless, of course, we may have individuals as well that are not looking to trade the trend and more looking at mean reversion strategies, for example, in which case definitely the Japanese yen and the New Zealand dollar would have been very beneficial. So let's start off with our first trading strategy. Now, people are probably looking at my chart and thinking, Michalis has only got 2 indicators on the chart. These are one of the most powerful indicators, ladies and gentlemen. The only thing they don't assist much on is volatility. Ladies and gentlemen, when it comes to support and resistance, when it comes to psychological pricing, when it comes to indications of investor sentiment, when it comes to indications of the trend and the direction and whether buyers or sellers are controlling the market, these 2 indicators are very powerful if used appropriately. Now, the only thing that they rank very low on, if anybody has ever worked in a trading floor or have seen a trading floor, you know, they look at these indications and they rank them. So for momentum, this indicator is ranked very highly. So for example, these 2, they're just not ranked highly on volatility. Whereas when you're looking at the rest, in terms of momentum, like I said, support and resistance, direction, whether buyers or sellers are controlling the market, it ranks very, very high. So what indications are we looking at here? Now, firstly, ladies and gentlemen, here we have an RSI, also known as a relative strength index, which is part of the oscillator category. That never appears on the price chart. It will always appear below the chart like so. And I've got this, ladies and gentlemen, on a period of 18, which is why you can see the number 18 on the top left. Now, we're using the RSI using 4 ranges. So we've got the range between 75 and above. So above this dotted line, let's get a pen out so it's easier for everybody to see. So above this dotted line here, in this area, we're looking at 75 and above. Now, between these 2 dotted lines, we're looking at between 50 and 75. Now, between these 2 areas here, we're looking at between 25 and 75. And then below, in this area, we're looking at 25. There we go. So these are the 3 ranges that we're going to be looking at on the RSI. Now, people probably have noticed this isn't the traditional way of looking at the RSI. It's not the default parameters. For example, if we're looking at the default parameters, we're actually looking at only 3 areas of the RSI, and that is using a dotted line at 20 and at 80. And the default parameters also looking at a period, ladies and gentlemen, not of 18, but of actually 14. So we've changed the and using it in a very different way, because we're not looking for it to assist with volatility, because we know it cannot help with volatility. It ranks very low. It's not accurate when it comes to volatility, but it's very accurate when it comes to other aspects. So we've changed it in order for it to be accurate and be appropriate and advantageous for the way we're looking at it in today's webinar. Now, the other is here, ladies and gentlemen. This is a moving average. For all those beginners out there, because I can see a lot of people asking questions. I'm a beginner. It's a lady actually said that this is my first webinar, so I'm trying to take it slowly with the namings and etc. But to be honest, if you've never traded before, you know, you're being chucked into the deep end, to be honest with you, because we're looking today straight at strategies. Whereas of course we've got other webinars where it's more forex basics, terminologies, how the market works, how does pricing work, and etc. So I'll try to go through it slowly, but at the same time I want to go through it at the right pace for those individuals that are going to be trading during a very volatile week and want to take advantage of this. So ladies and gentlemen, here the blue line is a moving average. It's very simply just giving you an average price movement. Now here we're using a 75 bar, so the period is 75 bar exponential moving average. Now what does that mean? Exponential moving average. It's still a moving average. It's not giving an average price. It's using a very similar calculation to giving an average price, but what it basically is doing is giving more importance to the latest volatility, more importance to the most recent price movements. So somebody's asked the question, is the price at 14? No. If we're looking at the RSI, ladies and gentlemen, you can see here that the RSI is at 18. So we're not looking at the default parameters. It's at 18. We've not got our levels, the dotted lines in simple terms, at 20 and 80. We're looking at them at 25, 50, and 75. So that way it gives us 4 regions, okay, 4 areas. So we've got 1, 2, 3, 4. Whereas if we're using 20 and 80, it will only give us 3. So how are we going to use this setup? The first thing I want people to be aware of is that I'm only looking at this setup on a 2-hour time frame. Now, in terms of accuracy, the larger and stronger the trend, it's extremely accurate when you're looking at these two indications as one setup. When there's a mean reverting pattern, it's less accurate. Of course, it is accurate still and still gives opportunity within the market, but it's less accurate. So here we're looking at the NASDAQ 100 technology-based index made up of 100 components. We're looking at a 2-hour time frame. So what are we looking for here in order to get an area where there's opportunity? Because at first we're going to establish the area, and then we're going to go into a smaller time frame and establish exactly where to put the stop loss, where to enter, where to exit, sell, buy trades, and so on and so forth. So ladies and gentlemen, when the price is above the RSI, it is an indication that buyers are controlling the market. So this is the area of the market that we want to mainly concentrate on purchasing and speculating the upward price movement. Now, whenever we're above and we're speculating downward price movement, it's at higher risk, number one. Number two, there's a higher possibility that it's going to be inaccurate. But if for whatever reason we deem that appropriate, so for example, at the moment, we're looking at the chart here. Of course, I'm not looking at the updated price, so keep that in mind. But let's say the price is above the 75 bar exponential moving average, but tomorrow's CPI comes in higher than expected, then of course, without doubt, if we're going to follow traditional routes, it's going to see a very, very strong decline. So of course, people want to speculate that rather than avoid the market just because we're above the 75 bar exponential moving average. So if we are going to speculate up, downwards, and we are above, we're always going to aim for our 75 bar moving average rather than a longer, stronger trend at first. Now, of course, If we hit our take profit and it collapses below that level, then we can look at more and more trades and use what is known as basically multiple entries, or for example, scaling in and scaling out methods, hedgehog methods as well. So this is something that you can use as well. So for example, here we're seeing a very strong decline. If people wanted to take advantage of that, then of course they would aim for that 75 bar exponential moving average. On that occasion, it worked perfectly, which is great. But even if somebody wanted to avoid that, very simply, you would have waited 6 hours, not very long. And then again, there's a lot of upward opportunity. So a good example is this area here. Another good example is this area here. So we're above the 75 bar exponential moving average. I can see 2 questions, so I'll answer those 2 questions in a moment. If we're below, so for example, here we are below, we're mainly looking at areas of the market to speculate downward price movements. Now, people may think this is too simple, and to be honest with you, trading is not like art. It's not like you're given a color book where it's a picture and you have to draw within the lines and you mustn't go above the blue line. It's not like that. The financial trader market doesn't work like that. So this is just a first step. Of course, throughout the webinar, especially towards the very end of the webinar, you'll see how it becomes more and more advanced. So these are just the first step. But to be honest with you, a lot of people think a million things can happen within the market. A million things can't happen within the market. It is either going to increase or it's going to decrease. And yes, if you're looking at portfolios in longer term, it becomes more difficult because it's going to increase and then decrease, increase and decrease, and so on and so forth. In the short term, it's much simpler because it's either going to increase or decrease. It's not going to do both. So keep that in mind. This is going to help a lot with the overall analysis. Now, ladies and gentlemen, the same thing applies when it comes to the RSI. When you're trading between the 50 and 75, that is an area where it's indicating that buyers are controlling. Now, if we're hitting 75 and above, like we are just about here, it's indicating that the price is overbought. So it doesn't necessarily mean the trend is going to change. You can see when we hit that indication approximately here, it doesn't stop moving upwards, but it just kind of moves sideways. We see an equal amount of upward price movement compared to downward price movement. So point number 1, between 75 and 50, buyers are controlling. That is an indication. Above 75, it's overbought, so maybe it's too expensive or it increased too fast in a short period of time, which is likely to trigger certain psychological and sentimental changes to investors. And if we're between 25 and 50, it is at that area, ladies and gentlemen, that sellers are controlling the market. Now, if we're in a scenario where these two are conflicting, we don't have a signal. So for example, if, should we say, for example, here in this area of the RSI, let's clean up all these drawings so everybody can see clearly. In this area of the RSI, ladies and gentlemen, we're looking at upward price movement. Whereas if we go up, we're actually here, ladies and gentlemen. Now, to be honest, we do see upward price movement. It's not incorrect if we traded, but it's easy to look at it when the price movement has already taken place and say it would have been a great trade. It's not that simple. You're not going to be able to see this, all this price movement here. You're not going to be able to see this. You're going to feel like you're trading blindly. So all you can see is the price movement up to here. Now, yes, we did see upward price movement, but it still helped us, the fact that the signals were so far conflicting, because we're trading, even though the RSI is above, we're trading here below the 75 bar. And like I said, it did help the fact that they are conflicting, because we saw up, down, up, down, up price movement before we started to see real strong momentum. So it still helped, and there's a reason why we say everything. This is one of the reasons. There was volatility, slightly mean reversion. We actually saw an ascending triangle pattern. So it's more difficult to trade than very simply trading the trend. And of course, it's easy to say the trend moved upwards because we already know that it moved upwards. When you're trading the live market, you won't know 100%. So ladies and gentlemen, this is the first step. So we need to identify all of this, ladies and gentlemen, before moving on to the next time frame. Now, there's two more things I want to mention. The first thing is, ladies and gentlemen, that of course we're still going to follow price action. Now, what do I mean by price action? So, for example, when we're looking at the price here, ladies and gentlemen, the first thing I want to note down here is that we are very, very far from average price. Now, think about it as buying a property. If, for example, you're looking to buy a property, maybe you're in an auction and you're bidding 100,000. Then somebody bids 110 and somebody bids 120, and you all keep bidding, and suddenly you've gone very far away to, on average, what you're paying. Then you're going to suddenly go, wait, no, I'm not willing to bid no more. So the same thing applies. So we need to look at price action still. So for the example, we're very far away from the average price, number one. Number two, we get upward price movement and we actually go to a higher high. So here, ladies and gentlemen, we've got a high, and then we go to a higher high. Now it collapses, okay? And then, we start to build momentum here upwards. So let's say we're at this price here. Now that price, technically speaking, we're still below the 50 on the RSI, and we're still below the 75 bar moving average. But we've got a higher high so far, and we've got a low and a low. So the low is higher, and the high is also higher as well. So that's something we definitely need to take into consideration. So for example, I know even though we're below the 75 bar and we're below the 50 on the RSI, that there's a slight risk there. And I keep that in mind. Why? Because we've got a higher high and higher low. If we were above the RSI 50 and above the 75 moving average, but we were seeing a lower high and a lower low, the same scenario applies. The other thing I want to mention as well is that we have divergence. Look at this box here, ladies and gentlemen. Now this box is moving sideways, okay? But if we're actually looking at the RSI, it's actually moving downwards. This is known as divergence. This is an indication of downward price movements, or at least a loss of momentum. So again, we can see here that we use it. This is part of price action as well. We're still using price action. Yes, we're using the 75 bar moving average. Yes, we're using the RSI, but we have to use still price action like this: higher highs, higher lows, divergence as well. And there's different factors for us to use. So it's not, you cannot look at the market blindly to say, I'm only going to look at a crossover and a couple of these indications, because if I put those onto the chart, they'll give me a signal and I don't have to think about how the market is going to move. If you look at the market in this way, you will be unsuccessful, because if everybody did that just to have 2-3 requirements, you just very quickly tick them after looking at the market for 5 seconds and then choose to trade, you're not going to be successful. So let's move on to the next slide. Let's look at the question before I move on. So in the MT4, how do I get the 2-hour time frame? You will not get the 2-hour time frame on the MT4. It definitely has to be the 2-hour time frame for this setup. You can download the MT5 for free. It's more or less the exact same. It just gives you some more time frames, not just a 2-hour. Gives you 3 hours, 6 hour, gives you a 6 minutes, a 2 minutes, a 3 minutes, a 20 minutes. So there's a lot more available. So definitely switch to MT5 if you want to use the 2-hour. Can it be used on a daily time frame? Not these parameters. This setup using the moving average and the RSI, yes, of course it can, but not with these parameters. The parameters will have to change in order for it to be appropriate. Now we'll go back to the Euro USD actually. Let's go to the NASDAQ, because we're looking at the NASDAQ. Now, ladies and gentlemen, I want to, and the NASDAQ actually this year, not just this year, for the past 2 years, has been seeing massive upward price movements. So especially when you're looking at a lot of educators online, they look at the easy signal, that one signal that was amazing, and they'll be only trading and looking at signals for the upward price movement because it's easy, because it's performing so well. I will show you with this signal how you can even look at the opportunity when the price is moving downwards, even if it's only temporarily moving downwards. So here, ladies and gentlemen, we can see we've got an indication that the price is going to decline. So for example, here now, ladies and gentlemen, we've got a high, the next high is lower, we've got the low, the next low is lower, we're trading below the 75 bar moving average, and we're also trading below as well, ladies and gentlemen, the 50 of the RSI. So we have clear indications here. We've got no divergence as well, which is great. Clear indications here that the price is moving and seeing an indication of downward price movement. So let's go to the NASDAQ. Now we're using different signals. Now here, ladies and gentlemen, I've got a 10 bar simple moving average, which isn't as important, but I always have it on my chart, and it helps me look at volatility, price action, because if it's moving very far away from the average price, then I know I need to be cautious. Same as well, if it's not moving away and it's just correcting and always staying around this 10 bar simple moving average, I know I need to be cautious that it's not trending and it's actually mean reversion type of price movement. Then we've got a MACD here, ladies and gentlemen. So how do I look at this? I've already established I'm only looking at downward price movement for the time being, because that's what I'm getting a signal on the 2-hour time frame. So I'll switch on to a smaller chart. Now I want to identify where to speculate downward price movement. So I'm going to look at how to pinpoint exactly. We're not talking about roundabouts. This is where we're thinking about it. No, exactly where to trade. So I'm looking at the 5-minute now. Now the lower lows and lower highs still apply. So I'm still going to look at price action. Price action is very important. Now what a lot of people will look at is breakouts. The issue with breakouts is that you're missing most of the price movement. So if the price movement is slightly weaker than you expected, there's a high possibility you will move into a loss and you'll hit your stop loss. Whereas if you're using the Fibonacci entry levels, then you're entering earlier and trying to make up a larger percentage of the price movement. So how do I use this? So we can see the price is moving downwards. I'm very happy. I can see we've got a lower low now. I wait for it to retrace. So I can see it's retracing. It's retracing, it's retracing, it's retracing, keeps retracing, ladies and gentlemen. Not an issue at all. Now, as it starts to gain momentum downwards here, okay, I know now that we have a lower low. And now we've formed the high. This is the high, this is the previous high. I can see that high is low. So happy days. Now what I do is I use my Fibonacci retracement levels. People don't know how to put them onto the MT5. I, of course, will show you. So I know this is the low, and I know this is the high here. So I draw my Fibonacci between the low and the high, and it will bring up these numbers here for me, ladies and gentlemen. Okay, so as the price gains downward momentum again, because all I want is for it to be enough momentum to signal that there is an opportunity that the price is going to decline substantially enough for me to profit. So as soon as it declines below the 65 here, that is where I'm entering. So this is the exact point that I would enter. The only thing I would double check after this, ladies and gentlemen, is that I want the MACD lines, the bars basically, to be below. So for example, here I can see the bars are above, here I can see the bars are above, here the bars are above, here the bars are above. So I don't want the bars to be above, I want the bars to be below. Very clearly I can see the bars are below here. So this is how I found the entry. So where did I enter? This here, let's get a different color, I think. Let's look at a yellow. So this here, ladies and gentlemen, this is where I entered my sell trade. How do I get to that? Because this is the low, this is the high. I've drawn the Fibonacci. As soon as it crosses below 65, sorry, I actually drew it at the wrong point. So it's actually slightly lower, so here. So I know as soon as it crosses below 65, that's where I'm entering. I double check the MACD. I can see the MACD's in the negative zone, so that's also indicating a decline. I can see I've got a lower low, and I can see I've got a lower high as well. So happy days. I'm speculating a decline there, ladies and gentlemen. Where am I putting my take profits? I'm actually putting my stop loss. I'm actually putting my stop loss up here. So I'm putting it above the previous high. So for example, if I've got a low here, and then I've got a low here, and then I open a trade here speculating upward price movement like this, I'm going to put my stop loss not here, I'll put my stop loss here. Okay, so that way I've got quite a lot of space here for volatility. Hopefully that's going to increase my success rate, which is very important, but we'll look at that towards the end of the webinar. So that's my first trade here, ladies and gentlemen. Now the next trade that I'm going to enter. So for example, we got lots of downward price movement. Where's the next retracement? This here is the next retracement, ladies and gentlemen. So this is the low, this is the high. I'm still seeing lower lows and lower highs. Of course, I draw my Fibonacci's between those two levels, and I can see my entry is here, ladies and gentlemen. So I'm speculating a decline here. Where's my stop loss? My stop loss is just above the previous high, okay? Because we're looking at downward price movement. So of course the stop loss is higher. So what does that mean? That doesn't mean we're going to put the stop loss here because it's very, very close to stop loss. We're going to put it, we're going to put it at the previous high. So the previous high is actually here, so just above this level here. So our first stop loss for the first trade is up here. Our second stop loss for the second trade is here. Now, people may also say that we've also got a retracement here. So I'm going to draw the Fibonacci and trade downwards on a third trade there. But no, that's not actually an indication. Why? Because, ladies and gentlemen, we don't have a lower low here. It's actually the same level, the low. And also, in addition to that, we're above the MACD here, whereas here, we're below the MACD. And also, in addition to that, a third point, we've got a high, and the next high is actually higher. So we've got a higher high as well, same level low. We're on the positive side of the MACD. So that's not a trade. So we have one trade here with a stop loss here. We have a second trade here with the stop loss here. All of these, I haven't looked at my take profits yet. I'll show you the take profits before actually moving on to the third trade. So where am I putting my take profits? Now, it depends on the volatility. So keep in mind, depending on the asset that you are trading, depends on the volatility. Now, if you're ultra risk averse, then you may aim for the 125, okay? Which is relatively close. Most likely somebody like a scalper will look at that level there. The only thing you need to be cautious of is your reward to risk ratio. If the stop loss is very far away compared to how much you're looking to earn. So this is if you're ultra risk averse. Most individuals would look at the 165 level. And of course, individuals may choose something in between. So for example, looking at 150. But these are the most popular areas. So you would have hit your stop loss, your take profit here, wouldn't have gone anywhere near your stop loss. So the second trade is here, like we said, and our take profit is here. So that would have also exited with a profit, didn't go anywhere near the price up to here. It did later on here, but at that point didn't go anywhere near it. So our next trade. So here we've still got the same level low, so I'm not getting any trades or indications there. Also, most of the time we're in the positive side of the MACD, so again, not seeing any indications there either. But now If I get my pen out, now we can see we've got a lower low here, and this low is actually low as well. So we've got a lower high and a lower low, and we've also just gone into the positive side of the MACD. So I've drawn my Fibonacci, and I've got the 65 point here. So this is the 65 point. Now I'm not putting my stop loss here, just above the previous high. I'm using the high before that. So the stop loss is actually just above, so somewhere about here. So again, it doesn't go really that close to my stop loss, to be honest with you. And again, somebody could have put their take profit here, could have put their take profit here, or somewhere in between if they wish. Either way, no matter what of the three you chose, would have been a profitable trade. Now, people, this isn't a one-off. I'm not looking at the greatest, clearest signal that's just very easy for anybody to use. I'm looking at the NASDAQ, which is most of the time in an upward price movement over the past 2 years anyway. And I'm pinpointing that successful trade speculating downwards. So it's not the easiest, and you're able to do it using this take on the market. Let's look at another scenario. This is the Euro USD, less trending than the NASDAQ. Of course, if somebody's looking to trade and speculate more trending markets, they may opt for the NASDAQ instead of the Euro USD. Somebody looking for more volatility and also continuous volatility, they definitely will look at the Euro USD. Also keep in mind it's got the lowest spread. The spread on average, off the top of my head, is about 1.5 pips, so it's very low. So again, same scenario here. So for example, here we can see clearly indications of downward price movement. We saw in this area here very clear indications that the price was very clearly being controlled by sellers. Of course, after that, they become oversold temporarily for approximately 8 hours, but then it crossed back above into the region between 25 and 50. So again, buyers controlling the market. We can look at other scenarios as well here. So for example, here, buyers controlling the market rather than sellers. And you can see that the RSI here. So very, very clear. It's very straightforward. You're still going to apply those higher highs and higher lows divergence scenario. So for example, this is a low, this is the next low. So I'm here, let's say, even though I'm below the 75 bar, even though I may be below the RSI, I know there's a strong possibility also that the price may increase. So I'm cautious. Doesn't necessarily mean I'm going to straight away speculate upwards, but I'm saying to myself, at least I'm not going to speculate downwards further for the time being. So again, we're using these indications, but we're using price action as well. So let's actually go to the euro. I don't actually have an indication chart for the euro. Let's actually go to the NASDAQ then, and we'll look at the same scenario. So here's the NASDAQ, trend based as well. This time we're looking to speculate the upward price movement. This is more recent. The indication we're looking at last time was actually from 2 weeks ago. This is actually just from a week ago. So it's a more recent scenario. So again, same scenario. Here, for example, we have a high, we have a low. I'm drawing my Fibonacci. I'm trading here. My take profits here. My stop loss is approximately here, ladies and gentlemen. Then retracement again. Retracement high, retracement low. I draw my Fibonacci between these two levels, and it's giving me 65. This is where I'm entering. This is my take profit. Stop loss for here is here, ladies and gentlemen. Then we've got another retracement. So this is a retracement high. This is the retracement low. 65 is here. My stop loss, ladies and gentlemen. So I'm not looking at this low here, looking at the previous low. So the low is approximately here. Now this is the first occasion it didn't hit the stop loss, but it went close to it. It's not an issue. You shouldn't be concerned. You shouldn't get all emotional about it. It may hit your stop loss. It's absolutely fine. You know, trading is like a business. There's turnover and there's expenses as well. A loss is very simply just an expense, as long as you're managing it and it's managed and it's responsible. So here we can see it didn't hit our stop loss, went close to it, and also it took longer to hit our take profit. The take profit was here actually all the way over here, so it took longer. These are all lower lows and lower highs here, ladies and gentlemen. A lot of the time we're below the MACD as well, so we're not drawing Fibonacci on any of those retracements. But the next retracement here, we can see high and a low, and we can see, look at a higher high and a higher low. So I do draw my Fibonacci, and I'm entering the buy trade here. Take profit was hit. Then we get another retracement here, ladies and gentlemen. Actually hit here. My stop loss would have been actually between below the previous low, which is down here, and I believe we've hit our take profit, ladies and gentlemen. Here the chart doesn't go that far ahead, so we're not 100% just yet. Let's look at another strategy. This is strategy number one. Strategy number two here is slightly different, slightly less complex, because that first strategy, you're going to look at price action, you're going to look at, yes, multiple time frames, slightly more indications. If that's complex, it's definitely the better, well-known strategy out of the two, but this is definitely something you can use as well. So, ladies and gentlemen, here we're using a different indicators. So none of them are the same. So we've got here also a 1 hour time frame. This is gold, one of our most traded assets. Not the asset with the highest success rate, but one of the most traded. Other assets, I believe the Nasdaq actually has a higher success rate from the top of my memory. So here we've got gold on a 1 hour time frame. This is the Bollinger Band, and it appears as 3 lines like this, also known as a type of a regression channel, but is an active regression channel. And then we've also got the parabolic SARs, which form as a dot like this. So we're using this to trade, but not so short term, and rather to look at it as longer term. Sorry, a slightly longer term. So instead of looking at more somewhere between scalping to day trading, this is more very clearly day trading, potentially can be slightly increased to swing trading. Now, what are we looking at to get a first signal here? We want the price to be between the upper side of the Bollinger Band like this, and the parabolic SAR dots to be below like this, in order to get indications of a buy signal. For indications of a sell signal, we want the price to be below in the lower side of the Bollinger Band like this, and we also want the parabolic SARs to be above. Very, very simple. So instead of looking like the previous strategy at different things, I've tried to strip it of everything and just give it as simple as possible. So very clearly we have 2 directions here, especially for our more beginner traders. Somebody says, why does the first strategy have a higher success rate? By the way, guys, if you've got questions, feel free to ask, of course. Because it's more precise, to be honest with you. It's more precise, it's more cautious, it takes more into consideration. Keep in mind, knowledge is power, data is power. So of course, it has a higher success rate. The success rate isn't the most important thing. At the end of the webinar, I'll tell you the most important thing. But nonetheless, of course, the higher the success rate, the better as well. So this is very simple, ladies and gentlemen. If we're in the upper side of the Bollinger Band like this, and the parabolic SAR dots are below buy signal. If it's below and in the lower side of the Bollinger Band like this, and the parabolic SARs are above like this, then of course we're looking at signals for sales. Then we switch on to a 15-minute time frame, not a 5 minutes. Keep in mind, in the previous strategy, we looked at 2 time frames, 2 hour and the 5 minute time frame. Now we're looking at different time frames. We're looking at the 1 minute and the 15-minute time frame. Now, ladies and gentlemen, what we're looking at here, we're looking at crossovers. Now we're only looking at the crossovers, which are in line with the directions on the 1 hour time frame. So for example, here, ladies and gentlemen, where we're below the lower side of the Bollinger Band and the parabolic SARs are above, we're only looking at indications of sells. Whereas if we're looking at here, where we're in the upper side of the Bollinger Band and the parabolic SARs are below, like here, then we're only looking at indications to buy. So we've switched now onto a 15-minute time frame, more shorter term. Very well-known day time frame, actually. Not very helpful for scalpers in ultra short term, very helpful for day time frame. So, ladies and gentlemen, here we're using crossovers to help us to enter. Now, what is a crossover? Now, when you've got, for example, one moving average and then a second moving average, now if it crosses over like this and it crosses over above, it's an indication buyers are going to start gaining momentum upwards. So there's an opportunity to speculate upwards. If it crosses below, then it's an indication of downward momentum. Now, we identified an area on that 1 hour time frame where we're only taking into consideration buy trades. So on the short-term time frame, the 15 minutes, we're not looking at downward crossovers. So where is a crossover? Here we've got our red moving average and we've got the middle line of the Bollinger Band. If it crosses downwards, I ignore it because it's not in line with what I'm seeing on the 1 hour. And also, this is also why a lot of people see a lot of unsuccessful trades, because they don't look at this and they don't think about that. It needs to be in line with that longer term time frame. It doesn't necessarily need to be ultra long term, like a daily time frame, in which case you're going to be not finding a lot of opportunity in the market as a short-term trader, because it's not for short-term traders as much. But for example, I ignored that indication. I ignored this indication. I ignored this indication. I ignored this indication here. Now, sometimes there is quite a lot of volatility here. There's a lot of volatility. It's a lovely trade. But if we're looking at 4 crossovers, this one wouldn't have been a good crossover, a good indication, because yes, it does move downwards, but very quickly loses momentum, moves in the opposite direction, which is of course something we want to avoid. This is a downward indication, was a terrible indication, didn't move at all downwards. This was also an indication, but again, moved very slightly downwards and then just crossed straight back up. So you can see here that even though there is sometimes where we do get that good signal, on this occasion, this time frame here, which is about 48 hours, there's only one signal that was accurate for downward price movement. So you can see here why I'm saying avoid it. This is an upward indication, lots of upward price movement. Here we actually get an upward indication as well, because it just dips below and then comes back up. If you want to take those into consideration as well, that's a very strong upward price movement. Here as well, very strong upward price movement. Here, again, we're still in a profit. Here, again, we're still in a profit as well. Let's look at a different signal. Here we're looking at oil, also something very volatile, more volatile than gold actually. Same scenario. So we've got our Bollinger Band. If we're in the upper side like this, sell signal, buy signal. If we're in the lower side like this, sell signal. If the parabolic SARs are above like this, indication of downward price movement. If it's below like this, indication of upward price movement. Very simple. So for example, ladies and gentlemen, at the moment, we're getting a slight indication of upward price movement here. Keep in mind, this isn't today. So it's not for you to go straight ahead and buy straight away. But here there's a slight indication. Now I say only slight. Why? Because it's just above the upper side of the Bollinger Band. We've only got 2 parabolic SLRs, so we just about have a signal there. And also still at the moment, we are on a lower low. All right. So sorry, the low is at the same level. So we can see here the low is the same level, and we're on the lower high. So it's not really a clear signal there, but it has potential to start to form a clearer signal. Again, Berkeley, straight away switch on to a 15-minute time frame, and I'll be able to see crossovers. So if we're looking at, again, indication of upward price movements, we have an upward crossover here. We've got an upward crossover here, upward crossover. We have an upward crossover here as well. We also have an upward crossover here, and we have an upward crossover here. This went into profit, definitely. This went into profit, this went into profit, this went into profit. The only thing, these two here, it's less certain yet if they went into profit, because of course we cannot see how far ahead the price has developed. This is the last thing I want to mention, something which is very, very important. I've got a question, so let me quickly answer this question. Somebody's asked if I can reply privately. Somebody's also, I've replied to that individual that asked for something, to be replied privately. I've replied. Somebody's also mentioned some more questions. How about SMC? It's not really related, to be honest with you. If you want more information on SMC, maybe send us an email, or we can have a one-on-one session. To be honest, it's less related here. Somebody says, I don't understand Fibonacci. I'll confirm how to use it live on the chart, based on how we looked at it today. So we will look at it live on the chart. So the last thing I want to mention, ladies and gentlemen, is the most important thing isn't the strategy and its accuracy. The most important thing is the statistics and mathematics behind your strategy. That is the most important thing. And I'll give you an example here that actually somebody, let's change the color, I think. Let's go back to red. Let's go to black, actually. There we go. Here we've got three very different traders, all right? And I want to show you why the accuracy of your trading isn't as important as the statistics and the fact of you trading responsibly being important. So here we've got John, we have Jude, and we have Mary, three lovely names. Let's say all of them, by the way, you can see are opening the same amounts of trades. So we've not got three very different traders in this sense. All of them have the same amount of trades. The only difference is they have different success rates. So here we've got somebody with a decent success rate. It's not high, but it's decent. It's something that's concrete and really can be worked on. And a lot of traders that may have been trading 4, 5, 6 months probably are going to fall into that category. 67% success rate. Here we've got 90% success rate. Here we've got 35% success rate. So maybe this is somebody maybe in his first week of trading or first month of trading, and he doesn't yet understand, has a very low success rate, is unable to determine how the market's going to move. So this is the only difference. What you'll notice is all of them are profitable, regardless of their strategy and how accurate it is, which is more or less the same thing as success rate. What you'll notice is their responsibility and how responsible and how they think about it, because they're thinking of it as a business. For example, Gucci know they'll sell less, but they make that which is giving them profit, give them a lot of profit. At the same time, should we say, fake brands or brands such as Gap or Primark, and other brands which are very similar, which actually have they sell a lot. They know that, yes, they sell a lot, but they need to sell a lot with a small margin, profit margin, in order to be successful. And the same thing applies to trading. We need to think about it as a business. It's not there just to make us a millionaire, in a year. It's not going to. So instead of doing that, let's try and make money, try and make profit by trading responsibly and trading safely. So for example here, we've got an individual who's opening 30 trades, has a 67% success rate. What does that mean? That means he closes 20 trades in a profit and closed 10 trades in a loss. All right, that's 67% success rate based on 30 trades. He kept no trades open. That's very important as well. A lot of people, they get sucked into the bad habit of keeping trades open without a reason, or just because they think it'll move back into their favor when it never does. Now, what's very important? The important thing is that he's looking at this and he's saying, how much am I earning? How much am I looking to earn? And how much am I looking to risk? So he's saying to himself, he wants a reward to risk ratio of 2 to 1. So he's going to look to earn, in terms of money, $40 per trade and risk $10 to $20 per trade. So if we take 40 times 20, and if we take 20 times 10, that means profitable trade is 800. Losing trades are 200. So he's got a profit of 600. Okay. The most important thing is not that he's got a success rate or accuracy of 67%, but that this here enables him to be profitable. So look at a different type of trader. This trader here has a high success rate, 90%. So he's got closes 27 trades a week in a profit, closes 3 trades a week in a loss. He allows a lot of risk compared to what he's looking to earn in order to have a high success rate. So he was willing to risk per trade 50, but is only looking to earn 10. So he has a negative reward to risk ratio. So a 10 to 50 or a 1 to 5. That's his reward to risk ratio. Now, based on 10 and 227 is 270, and 50 times 3 is 150. So he's still in a profit of 120. Then we've got a different trader. Still, Mary's opening 30 trades a week. The only difference is she has a terrible success rate. Her success rate is 35%. So from 30 trades, 11 trades she closed in a profit, 19 trades every week she closes in a loss. So a very big difference there. But because she knows that, she's looking to earn $32 per trade and only willing to risk $8 per trade. So it's a positive reward to risk ratio of 4 to 1. So her turnover is 363, so profitable trades, and her expenses is 152. So she's still in profit, ladies and gentlemen. So whether you are great at determining how the market is going to move or not, or somewhere in between, looking at how much you're going to earn and risk and sticking to it strictly, under no circumstances changing it and just keeping the trade open and open and open forever and ever until it wipes out your account or leaves you with a very small amount. Look at this, the mathematics behind trading, because that can make a big difference. So that brings us to the end of today's webinar, because we've been speaking now for 1 hour. Let's end with a poll. So let's launch today's poll. Will gold climb to a new high in 2024? So by the end of the year, so in the next 6 months, will gold climb to a new high? Let's see how many people vote. Only 10% have voted so far. Let's see if we can get some more votes. I will only allow 30 more seconds. 67% have voted. I want at least 75% to vote, and then I will share the answer. So will gold climb to a new high in 2024? Okay, so we've got 70%. Come on, guys, let's get at least 2-3 more votes. We've got 1 more vote. Great. Some more votes, guys. 5 more seconds. 5, 4, 3, 2, 1. Right, ladies and gentlemen, so 70% believe that gold will reach a new high in 2024. 70%. 30% do not believe it will reach a new high in 2024. Now, if I've got anybody that has any more questions, feel free to ask now. If anybody has questions. I'll only leave the slide open for a minute or two. If somebody has questions, feel free to ask. Otherwise, we'll end the session. We also have a webinar tomorrow. We also have a live stream webinar tomorrow as well. Okay, so I can't see any more questions, so let's end the webinar. Everybody, of course, trade responsibly and safely. If you have any questions or want one-on-one sessions or want to send us an email with some questions, feel free to do so. Otherwise, we'll see you in the next webinar. Enjoy the rest of your day. Good luck to everybody. Hopefully you found today's webinar educational and informative. In the meantime, we'll speak again next time. Goodbye.